Joining us right now, John Hilsenrath, Wall Street Journal Chief Economics Correspondent. John, good to see you.
Good morning, Maria.
We want to talk about rates, the banks, and the employment numbers out tomorrow. First, Let's talk about rates and what's driving yields lower across the world.
Well, you know, there's a couple of things going on here. One is a flee for safety. Investors all over the world, especially after Brexit, are looking for safe places to put their assets. And there really aren't very many places. The Treasury bond is the global safe haven. You know, it's kind of like replace gold as the place people go in times of trouble, and that's what's pushing yields down. The trick here is that how do you interpret that? Is that a sign? Deutsche Bank put out a report just the other day saying that this drop in yields is a sign that recession probabilities are increasing. But it's hard to know if this is just people searching for safety, or if it's a real sign that their expectations for growth are going through the floor.
Yeah, Dagan, we keep seeing worries about recession.
Right. And John, how much of the drop in government bond yields is driven by central banks around the world? I know the Wall Street Journal covering that extensively today.
Right.
But again, are they... It gets to your point, how much can you read into that yield as a sign of fear?
It's another example of why bond yields are artificially depressed right now. You're absolutely right. You know, the Fed has stopped adding to its portfolio, but every week it's basically re-upping its portfolio, so it's still very active in the Treasury market. And then now, meanwhile, you've got the Bank of Japan, which is out there very aggressively buying JGBs, Japanese government bonds, and you've got the European Central Bank, which is buying not just government bonds in Europe, but also corporate bonds. So central banks are a really big player here. They depress something called the term premium, which is the extra yield that people expect to hold longer-term assets. They've really depressed that. I mean, bond yields are negative in a lot of countries right now.
Unbelievable.
Switzerland, UK. You know, this is all a sign not just of weak growth, but also the extent to which central banks are trying to boost global growth.
So, John, with this news on bonds and with a tumultuous stock market, where can investors go to get some yield?
Well, I mean, the whole reason that the central banks are doing this is because they're trying to force investors into other assets, other asset classes. So it's one reason why you have this real dichotomy right now, right? So you've got bond yields extraordinarily low. Like 1.4% in the U.S. is actually much higher than a lot of other countries. And then at the same time, you've got stock prices near 18,000. It's because the central banks are driving investors into riskier asset classes.
Right, sure.
To try to increase risk-taking in the economy.
John, well, speaking of risk-taking, we'll see what the jobs number brings us tomorrow and if that impacts the stock market. I want to ask you your expectations on jobs, and also the story in the Journal today, top of the C-section, market value of the 20 largest banks has been cut in half this year. Wow, the banks are really taking a massive hit on the Brexit as well as these low rates.
Brexit and also low rates, exactly, Maria, because what happens when they can't earn a decent margin, when rates are negative on safe haven long-term assets, and they can't earn a decent margin on their deposits, you see their profit margins compress, and that's one of the things that investors are punishing them for. You know, I wrote earlier this week about this jobs report. I think the market needs to look out because, you know, the inflation numbers in the United States have picked up. Stanley Fischer last week said the economy isn't doing that badly. If we get a couple of months of good jobs reports, we could see the market recalibrating when the Fed is going to raise interest rates next. You know, right now, they see almost no chance of the Fed moving rates up this year. And if we get a couple of strong jobs reports, if we reverse what happened in May on a very weak jobs number, then the market might have to recalibrate that, and the pretty decent stock gains that we've seen over the last few weeks could reverse.
We'll see about that. I mean, the last jobs number was 38,000. That wasn't good. And then there are also expectations that we might not see rates move until 18. I don't know, John. We'll see about that. We'll talk to you after the numbers. Okay. John, thank you. John Hilsenrath.